Hello, everybody. Eddie Ardeni here. Thanks for joining me again. I hope you had a good week. And already it's August 7th. So before you know it, it'll be September. September has a reputation of being not such a great month for the stock market, but we'll see how that plays out. It's been a great a month so far in August. The first 7 days have been spectacular here in terms of the weather. It's been almost spring-like, no humidity, and kind of in the high 70s, low 80s. So it's been great. I hope it's been relatively good where you are. At any rate, today it's raining, and there are lots of people who still have damp concerns about this market. But on the other hand, the bullish sentiment indicators suggest that there are a lot more bulls than there were way back when in October 12th, when the market bottomed. Now that the view of a hard landing has diminished in its credibility, and there's more people in the no recession camp anytime soon, even reading some articles saying there could be a couple of years before we have to worry about a recession. So now that sentiment seems to be turning more optimistic, we want to be alert to what can go wrong. We still remain bullish, though we think that the market, the S&P 500, may just still come in at year-end at 4,600. So given that it's at 4,500 or so, there isn't a lot of upside in the market. But on a rotational basis, we could see the mega cap 8 stocks take a breather here as higher bond yields maybe put some pressure on the valuation multiple. And on the other hand, we could see some of the laggards catching up. Energy has been doing quite well recently. Financials have come back nicely from the financial crisis sell-off. And industrials, I think, still have a ways to go. They've had a good rally, so maybe they're going to need a little correcting here, but I think they certainly have the fundamentals going in their favor. Well, you know us, we prefer to be optimistic rather than pessimistic, but the most important thing in this business is to be realistic, no matter which way you're wired. And so we're keeping tabs on a worry list. The worry list that I'm working on updating for tomorrow is as follows. One, commercial real estate crisis. We all know about that. Another is renewed wage price spiral. Now that UPS is behind us, we've got United Auto Workers that are threatening to strike unless they get a big pay increase. Another risk, of course, is that lo and behold, the pessimists, the naysayers, turned out to be right after all, and the consumer retrenches, either because they've spent enough on goods and they've kind of maxed out on their travel plans, and they come back home and decide to just give it a rest for a while. Or of more concern would be if the labor market continues to slow, in which case that would have an impact on real purchasing power and then on consumer spending. Another concern is the bond vigilantes go on a rampage. We've seen the bond yield go up from like 3.3% right after the banking crisis in March. Interest rates took a tumble, but now we've got the bond yield back over 4%. People like Bill Ackman are talking about the 30-year going up to 5.5%. So there's a sort of mounting amount of bearishness going on in the bond market. And if the bond vigilantes decide that the Fed needs to tighten some more because inflation isn't moderating quick enough, and or they are concerned about crowding out, that the fiscal stimulus provided through spending on infrastructure and incentives for onshoring and so on, if that creates sort of a crowding out impact, that the only way that you can sell bonds, that the government can sell bonds, is at higher rates, that could obviously have an impact on the valuation multiple. It could also have an economic impact. The fifth related one is the federal deficit spirals out of control. We know that as interest rates have gone up, so has the net interest component of outlays, and that's of concern, and it can feed on itself, because if it creates a bigger deficit, that creates more concerns about the size of the deficit. I've always been of the opinion that deficits really don't seem to matter all that much to bonds. Historically, you've had some of your biggest bond rallies when the deficit was widening. Well, that's because they coincided with recessions. But here, this time around, we've had very stimulative fiscal policy before a recession ever hit. And maybe that's why the recession hasn't hit. And as a result of that, we've seen interest rates go up. And because of the amount of debt currently outstanding, it's kind of feeding on itself. So the federal deficit is a concern, and it's something that the bond vigilantes are concerned about. And last but not least, as the Fed goes Volcker, the idea there being that, we've made a lot of progress in seeing inflation coming down. But if you combine some of these other concerns, like the renewed wage price spiral, like a concern about the federal deficit being out of control, you put those all together, and that could reaccelerate inflation and force the Fed to conclude that the only way to bring inflation down is with a recession, by raising interest rates to whatever level is necessary to do that. The problem with that, of course, is since the deficit's already large, without a recession, the deficit would get even larger. And so, you could certainly paint some pretty doom and gloom kind of scenarios in that kind of outlook. So these are things we're worrying about. Our attitude for the past year and a half is, I don't want to be glib about it, but it's been kind of don't worry, be happy. And that's worked out, especially since October. Now it's worry, but be happy. Let's maintain our optimism, but let's at the same time make sure that we're realistic about what the risks are. Well, with that, let's turn it for a look at some of the charts that support the story that we told today. So let me share my screen. And the story we told today is that the irony of it is that as the hard landers have lost their credibility, or some of their credibility, some of the economic indicators that came in with the employment report suggest that things are actually still slowing down, and that we could actually have the index of coincident economic indicators go flat in July after being flat in June. It could even be slightly down. And I'm a big fan of the index of coincident economic indicators because it's a monthly number, and its year-over-year percent change is a good monthly correlation with real GDP. So we want to watch that. And so let's get into it. Well, whenever the employment numbers come out, we now kind of take a leading and coincident economic indicators approach to those employment numbers, because payroll employment is one of the four components of the index of coincident economic indicators. So here's the coincident economic indicators. I've been pointing out that while the leading indicators have been declining since December of 2021, the coincident indicators have continued to climb to new highs. But we don't want to ignore the fact that there is obviously some value in focusing on the index of leading economic indicators. But I've also diminished that value by saying that to a large extent, the LEI is very biased towards goods in the US economy. And we know that the goods economy is in a recession, but the service economy has been strong. Fiscal stimulus on infrastructure has been strong. Consumer has been spending on services, and so that's kept the economy growing. But I will be sensitive to that number. And here you can see that, as I said, if you take the year-over-year percent change in the coincident economic indicators and correlated with real GDP on a year-over-year basis, same scale. So you can see just it's not just a correlation, it's a tracking model. And here the coincident economic indicators in June was up 1.8%. It'll be up somewhat less than that if they're flat in July, but it's still growing. It's still not a recession, and that's still my scenario for the outlook through the end of next year. So again, payroll employment came out on Friday. Here's the July number. It was up, but less than expected. That, by the way, has a bearing on the Citigroup Economic Surprise Index, which is a good short-term indicator for the bond market. So perhaps we're now, after seeing a slew of indicators turn out to be better than expected, causing the CESI, the Citigroup Economic Surprise Index, to go up. Now maybe that index will start going down a bit. So payroll employment, all-time record high, but slowing. Now, we do know that based on payroll employment, we have a good glimpse at wages in personal income, real personal income, and wages increased, wages and salaries, total wages and salaries increased, but at a slower pace, because not only did payroll employment increase at a slow pace, but we actually saw a decline in the average work week. On the other hand, that was offset by an increase in the wage rate. And so that's something to be factored in, and we do factor it into something we call the earned income proxy. We'll look at that in a second. But clearly, if real personal income is going to weaken along with the indicators from employment, then that's could very well have an impact on manufacturing and trade sales. Again, these are real numbers as well. And we do get retail sales next week, and that could possibly turn out to be weaker than might be expected because of what we're seeing in our wage numbers related to what we saw in the payroll numbers. Manufacturing and trade sales, manufacturing shipments might be weak because industrial production or manufacturing production has been weak for the past couple of months. And then industrial production, as I said, has been weak. And the July indicator that we have an aggregate weekly hours worked in manufacturing in the payroll employment data was flat again. So there's really not much, there's no growth in industrial production. So the four coincident indicators are looking flat to possibly down a bit, just as everybody's getting more excited about no recession ever again, or at least not for a while. Payroll employment. Another set of indicators we look at is sort of coincident to leading indicators. We went through all the payroll employment numbers to try to see which ones have the most sort of cyclical forecasting power. And we came across truck transportation has been flattening out after going up substantially. That might have something to do with the goods recession, less merchandise being shipped to retailers because they got too much inventory and that they still have to work through. And then temporary help services is showing a decline here, and that has some history. So again, we're on alert, and there's a few things to be alert for. Here's another one. In payroll employment, we have aggregate weekly hours, total private industries. It downticked in July. Again, we had the increase that we had in payroll employment was more than offset, though slightly, by the decline in the average work week. So when we take the year-over-year percent change in aggregate weekly hours, it's total hours worked, it kind of makes sense that it would be a pretty good indicator on a year-over-year basis of coincident economic indicators. And the aggregate weekly hours is slowed to 1.3%. So if you look at the red line, you can see that it's been slowing down through July. Aggregate weekly hours again slowing, and you can see its correlation with real GDP. So all I'm saying is that the payroll data, the employment data that comes out at the beginning of the month has a lot of information content that I think has been largely overlooked because everybody gets sort of into the minutia of the specific numbers. When you take a step back, you can see that there's some very important macroeconomic relationships that we get a strong indication of with the employment numbers. And right now they're looking on the soft side, soft landing side, rather than hard landing, and of some concern, obviously, if they continue to slow. This is what I mentioned before. This is our earned income proxy. It's simply total payroll employment multiplied by the average weekly hours, multiplied by wages on an hourly basis. And you can see that it's been on an upward trend. It rose in July to a new record high, but the pace slowed, and that's adjusted for inflation, may be kind of a flattish month for purchasing power. And we may see that in retail sales, particularly retail sales, because consumers still show no signs of pivoting back to goods. Right now, they're still on vacation in Europe and other places. And so again, retail sales, this is the retail sales total number, bears some correlation to wages and salaries, but it's been flatter because of the pivot to goods. On the other hand, auto sales picked up a bit, 0.6% month over month in July. So that could be something that helps retail sales when the data comes out next week for July. Here's what I mentioned before about industrial production, manufacturing production. This is what the number looks like. As you can see, it's been weak in June, and the July number for aggregate weekly hours in manufacturing doesn't really look like it's going to suddenly turn up, and it could actually turn down. So again, a lot of weakness in the goods sector. I mentioned before the Citigroup Economic Surprise Index. You can see that it's been surprisingly strong as the economic indicators have come out better than expected. It's helped to sway everyone that maybe this recession isn't imminent, but it is very volatile, and it does. Once it goes up, at some point it goes down as people get maybe too optimistic about things on the way up. So we're looking for some weakness here in the index, partly because we're still sticking to the view that the bond yield peaked at 4.25% last October, and here we are almost back to 4.25%. So, if we see this market push bond yields above that, I think that's where the stock market really has some risks over the next several weeks. Average, then we did a lot of work on average hourly earnings. It's another number that comes out with payroll employment, and everybody got excited about the slowdown in employment as possibly being a precursor to providing a good reason for why the Fed should take a rest, should pause. On the other hand, when the wage number came out, it showed an increase of 4.4% for all private sector employees. And that was the same as the month before. So the word sticky kind of suddenly was being discussed, that the wage inflation could be sticky and that maybe it's not going to continue to moderate. The trend is still for moderation here. This is 80% of the workforce is included in production and non-supervisory workers. And that inflation rate clearly has come down. It's ticked sideways. I mean, these things rarely go straight in one direction or another. And so I still think we're looking at a moderating trend in wage inflation. I know that unions have been getting some big pay increases here, as have, and now we have another one, the United Auto Workers, that are going to be pushing through. But union workers are still a fairly small percentage of the labor force. And I think we're starting to see that some of the biggest increases in wages we've seen are starting to slow down, particularly in the services economy. Here's a chart of wage inflation for higher wage workers, all workers, and lower wage workers. And you can see that the higher wage workers have actually been getting less on a year-over-year basis than the lower wage workers. And that makes sense. That's where the labor shortages have been in the industries that hire people that get a lower wage. And they've been getting some decent increases of late, whereas salaried workers, higher wage workers have not been doing as well. And some of those, of course, are union workers, and that might explain why we're seeing the union workers more aggressive in trying to get some pay increases. Figure 14, you can look at on your own. We discussed it in the morning briefing. We looked at the various industries, and mostly what we're seeing is moderating in wage inflation, though there's clearly some areas where we're still seeing some upward pressure on wages, like manufacturing, but they can offset that with productivity, in my opinion. So here we've got the employment cost index, another measure of wages and salaries. It also includes benefits, but we can compare that to the data that came out on Friday, and we still see a moderating trend in both of these measures of wage inflation. There's the employment cost index. This is the employment cost index of wages and salaries. This includes the full view of total compensation and employment costs, including wages and salaries and benefits. Too soon to say that this is a definitive top, but we think it is. Here's a chart on the ECI compensation, total compensation, wages, salaries, and benefits. Benefits are always important, especially in union contracts, and you can see that the union workers have been getting smaller increases than the non-union, so hence we've got this upward pressure. And so this may move higher, but we continue to believe that the majority of the labor compensation will be continuing to moderate. This is the ECI versus hourly compensation. Hourly compensation is the most comprehensive measure of wages, salaries, and benefits, but it's also among the most volatile, as you can see. On a year-over-year basis, it's even volatile, and you can see that it ticked up to 3.7%, which is actually a fairly moderate level of labor compensation. This is just another chart of hourly compensation versus average hourly earnings. This may be too granular for some of you who don't necessarily want to get into the weeds on all this wage stuff, but here's the punchline. The punchline is if you take hourly compensation, which again is the most comprehensive measure of compensation, including wages, benefits, but wages, salaries, and benefits, though it is volatile. But if you divide that by productivity, you get unit labor costs. And then if you take the year-over-year percent change, you get a pretty good number, 2.4% in the second quarter. That's a real moderation in the underlying inflation pressures. And you can see that unit labor costs on a year-over-year basis are highly correlated with the headline CPI, which came down to 3%. Thursday is the big number, the big day, make or day. Every one of these numbers seem to be make or break these days. We're thinking it's going to be confirmed that the CPI is moderating, and we would expect to see 3% or less on the CPI. But as we discussed in quick takes, there's something that I think the Cleveland Fed puts out that suggests that the number could be 0.4% month over month for both the headline and the core, which would push this number higher. And again, lead to people talking about sticky inflation. What else do we have here? Oh, we got the wage growth tracker, which is not my favorite indicator, but it's the fourth wage number we watch, and that's looking like it's coming down. It bears some correlation to average hourly earnings. This is kind of an interesting one for why it's worthwhile looking at the wage growth tracker. You can see that job switchers and job switchers have been getting higher pay increases. Obviously, a lot of them moved to get a bigger pay increase, but it looks like switching doesn't yield as much of a pay increase as it did a year ago. And so that may be a sign that things are kind of calming down in terms of the turnover in the labor market, which then creates wage inflation pressures. And that may be related to the quits rate. The quit rate tends to lead by 6 months the employment cost index in wages and salaries. So it's predicting that this blue line, wages and salaries, 4.6% now, may very well go down to under 4% within the next quarter or two. And we have a similar kind of chart, quit rates versus average hourly earnings, and the correlation isn't as tight. But again, to the extent that the labor market turnover has been a source of wage inflation, that's something to consider. So with that, let's open it up to some discussion, some questions. I got one so far. Let me see what we've got going here. So let's take the questions. I'm just looking at how many of you have joined, and I appreciate the nice turnout. So Cagdus, how do you split the probabilities for a potential temporary stock market correction between now and September, coming with falling longer bond yields, that is economic worries, or higher long end bond yields, restrictive discount rate? Well, I think we're at a point here where the bond market is going to call the shots for the stock market. A lot will depend, of course, on a near-term basis on the CPI and PPI numbers we get on Thursday and Friday. A lot will depend on the reaction of the bonds to supply. There's lots of supply coming. I've, over the years, observed that the bond market isn't that much driven by supply and demand in the bond markets, driven by expected inflation and expectations of what the Fed will do about actual and expected inflation. But we're in a different world here since the pandemic, and we're certainly in a different world when it comes to the size of the deficit, the size of the debt, and the compounding of interest. So I've been saying for a while, when people ask me about the deficit, don't you care about the deficit? I said, I'll care about it when the market cares about it. And I have to conclude that the market probably does care about it. So it is a concern, and it is a possible factor here of why we could have the bond yield jump above 4.25%, the October 24th high of last year. I think technically that would be an important level to crack. And so if it's because of the supply, that'll be an ongoing issue in the bond market. And then if we get whacked by a really unpleasant CPI and PPI, I mean, higher than expected CPI and PPI, that's going to be a pretty awful scenario on a short-term basis, and would be a reason why I think the stock market could easily slice through its 50-day moving average and on its way to the 200-day moving average. There's a channel that I've highlighted in the quick takes, which I'm sure I hope you've seen. But I'm counting on signs that inflation is continuing to moderate. I'm finding myself back in the camp, hoping that the economic indicators aren't too strong, but aren't too weak, that they still remain sort of in that soft landing category, in which case the bond market holds 4.25%, in which case maybe there's more downside in the stock market, but not a heck of a lot. Chip, can you add your touch points on the Fitch downgrade? I think the Fitch downgrade just reminded everybody that we've got a deficit problem. And I think, again, the market has basically been ignoring the deficit, but it's ballooned on a 12-month basis from $1 trillion, 6 months ago, to over $2 trillion now. And so it's getting everybody's attention, and the Fitch downgrade just, caused me and everybody else who's got a chart on the federal deficit to show, well, Fitch isn't wrong. There is a problem, and Fitch isn't wrong about the interest compounding and the political issues of the inability of Congress to deal reasonably and responsibly with the deficit. So I think that just brings to the fore that the deficit may very well matter again, whereas up until now, it doesn't seem to have mattered. I mean, even QT didn't matter, right? The Fed was reducing its portfolio of treasuries by $60 billion per month. The federal deficit is ballooned, and yet the bond market didn't seem to respond to any of that. Now that's something we should be putting on our radar screen as a concern. And it's the reason that I'm not raising my year-end target on the S&P 500 above 4,600. We got there way ahead of schedule. And I think given these issues facing the bond market with the deficit and concerns that the nervousness about inflation, I think the stock market's probably going to need to go sideways for a while, particularly as the valuation multiple of the mega cap 8 has already had a big run and may need to slow down. Lewis, is there a chance that the core PPI will be negative on Friday due to falling goods prices? There's a very good chance that the core PPI will be negative. The year-over-year percent change in the US PPI is very highly correlated with the Chinese year-over-year percent change in the PPI, and the Chinese PPI is actually a leading indicator for the US PPI. So there's a good chance that will be negative. The Cleveland Fed, as I said, is looking for 0.4, 0.4 for a headline and core month over month. But there's something called Trueflation, which is a private venture that is on the internet that's talking about numbers more like 0.2, 0.3 kind of numbers, which would be obviously greeted favorably by the market. Take a look at the quick takes we sent a couple of days ago on that, and we will be updating that. Ted, once a trend starts like lower wages, how hard is it to reverse this trend? If a wage slowdown is a forerunner of slowing growth, would this drive us to recession? Conversely, what incentives are there in industry to raise wages, particularly if inflation reduces margins? Well, I think we are seeing, at least over the past year, a moderating trend in wage inflation. I think over the past few months, we've seen that even though wage inflation has slowed, it's still running above inflation in prices, headline prices. Food and energy matter, obviously, to real purchasing power. So we can have a situation where wages that continue to rise faster than prices because productivity makes a comeback. That's my story. That's the optimistic story. If that doesn't happen, it's not going to be a happy story. The growth rate of the economy is dependent on productivity and labor input. Labor input has slowed down dramatically with the shortage of labor. I think productivity is making a comeback, will continue to make a comeback, and that'll allow wages to rise faster than prices. So I don't mind wages going up as long as they're going up faster than prices and we don't see a wage price spiral. There is a concern that with these high visibility union contracts, that will spread to another renewed wage price spiral. I'm concerned about that, but I don't think it's going to happen, or it's a low probability story. I'll end up with Gus. I apologize to those of you that I think, okay, Gus, and I apologize as I got on the call late. Any thoughts on the productivity report, which was much better than expected? Yeah, I mean, it was a great report, except even as much as I wanted to believe it, it was somewhat hard to believe the notion that the labor input, that output was up 2.4%, and the labor input was down a bit, which makes no sense relative to the monthly numbers we get. I did lob a email into the Bureau of Labor Statistics to see if they could explain that why there's a discrepancy between the productivity numbers measure of labor input and what we're getting from employment on a monthly basis. But I like the number a lot. I hope it's the beginning of a trend, and I think it might very well be. But I have to be true to my of the data and tell you that still looking into it to make sure that I understand why it turned out to be a lot better than anyone expected. Well, with that, have a really good week. I know it's not going to be an easy week in terms of fretting about some of these developments up ahead here. How will the bond market respond to the supply of securities? What will the CPI do? What will the PPI do? And I'm sure there'll be other fun things happening this week. So let's all get through the week. I think it'll work out all right on balance. So have a good one. Thank you. See you next week.